Hello, everybody, and welcome to another episode of Capital Ideas, where we celebrate the ideas that enrich our lives and the capital markets that turn those ideas into reality. I'm Nick Morgan, the co-founder of ICANN, Investor Choice Advocates Network, and one of the co-hosts of today's episode of Capital Ideas.
I'm Mark Hiraiti, a co-host of Capital Ideas and Senior Legal Director and Policy Counsel at ICANN.
And I'm Dara Albright, co-host of Capital Ideas and a very proud board member of ICANN. And today we are joined by Jim Dowd, who's the founder and CEO of North Capital, a regulated fintech firm that's modernizing capital raising and secondary trading across the $3 trillion exempt securities market, including tokenized securities, which is what we're really going to dive into today. Jim joins to discuss the potential of the asset tokenization market, which many on Wall Street see as a transformative force in finance. We're looking at projections anywhere to go from roughly 600 billion today to as much as 16 trillion by the end of the decade, and the potential to unlock even hundreds of trillions of dollars in value across real estate, bonds, equities, and all different types of real world assets as they move on to digital ledgers. So with that, welcome to the show, Jim.
Thank you. Thank you very much for having me.
Well, first, congratulations on the recent partnership with T0. We are going to dig into that shortly as we get into the session here, but let's start with the big picture. Why is tokenization resonating so strongly with traditional finance institutions now?
It's a great question. I think that there are different reasons depending on the segment of the market. And what we're most involved with and what I'm most familiar with is the private markets, where really we have had a lack of infrastructure of any type for a number of decades, and the opportunity that exists with tokenization to provide open, transparent, public rails with open source software that sort of almost appears purpose built for private securities is really the reason why we're very excited, because it's the first time that we can potentially solve some of these infrastructure related problems that have existed for so many years.
Jim, I think our audience certainly understands the benefits and opportunities with tokenization, and now Wall Street is clearly becoming aware. But given those opportunities and benefits, what do you think has been missing between the promise of tokenization and the reality of the private markets today?
I think that the market has kind of evolved more slowly than I would have expected. And it's really a combination of, market cycles, maybe suspending some of the initiatives that started early on, also some regulatory uncertainty that has since been clarified in the US. And then I think, a number of people have sort of characterized tokenization as a problem, solution in search of a problem, and not everybody could agree on the problem. So as I mentioned, our focus has been on, more on the private markets, but there's actually been a lot of attention in the public markets to use tokenization as a way to create 24-hour settlement cycles, to eliminate some of the manual collateral transfer issues that exist in that market, and to also expand access to public securities outside of the US. That's probably one of the ones that I least expected would be a potential benefit, but is frequently talked about by public focused broker dealers.
I think as the wider community adopts tokenization initiative, there's a common narrative that getting something on the blockchain itself, tokenization itself, is the key to unlocking liquidity. You think is that a little superficial, or is there more to it than just that?
I think it's superficial in the sense that it's necessary but not sufficient. And the mistake that I think a lot of people, maybe who are not experienced in markets and market dynamics, is the idea that the only barrier to creating liquidity in sort of every asset is the ability to create sort of scalable settlement rails, which really is what blockchain is probably best at, is kind of creating a mechanism for settlement and record keeping, as opposed to, per se trading. It's not, there's really no trading system that's kind of built into blockchain. It's really post trading is where the value is really delivered. And what we've observed in private markets that are not on blockchain is that there definitely is an important step in creating a venue, a market venue for trading, and publicizing, alerting the market that this venue exists and that the opportunity to transact is there. But that in and of itself doesn't create interest in the underlying assets. I mean, we have illiquid, underfollowed assets that are public securities, and we have, similar assets in the private market. So I would say it's necessary but not sufficient to have kind of standardized rails, standardized systems to, create the potential for liquidity. And that's really the way that we try to characterize it when we're talking to our prospective partners.
Could you talk a little bit about Agora, which is the partnership between you and T0, and so maybe introduce that to the listeners, and then we could talk a little bit about how specifically that could help with growth and adoption of tokenized.
Sure. Yeah, no, and thanks for asking about it. So this is a relatively new initiative that we announced jointly with T0, and it's designed to address a particular problem that we each had separately observed in the market, which is that to the extent that there has been the development of regulated secondary markets for private securities and tokenized securities, they have developed as individual sort of walled gardens, individual silos, where we have the securities that are listed on our ATS. We have about 1,200 right now. T0 has the securities that are listed on their ATS, but really it's a bilateral relationship between the ATS and then our universe of customers, or their ATS and their universe of customers. And we've each implemented our ATSs in slightly different ways in terms of who can access the ATS and how the settlement process works. And there are other ATSs that have similarly set up their own systems and their own procedures. And what we realize is that there's really a significant networking opportunity that's been missed out upon because of that structure, where our clients don't have the ability to access other ATSs, and their clients don't have the access to access other ATSs besides theirs. And so the idea was, and we've been talking to T0 for, really for years about how could we, what is the market going to look like in the future, and how, I mean, we work together. And we kind of jointly came up with this idea that maybe the way to sort of at least create more of a network effect is to have a technology layer that sits on top of sort of initially our two ATSs, but eventually other ATSs as well, to enable people to essentially access one technology layer, but to get to multiple marketplaces. So it's almost like creating a bazaar, if you will, of multiple vendors with their individual relationships. And the key benefit to the structure is that we don't have to change the way we do things for our existing clients. They don't need to change the way that they're doing things for their existing clients. It should be additive rather than requiring a reworking of the system. So that's kind of the way that we're designing it, and the way that it'll be rolled out.
That's really interesting. And, the whole topic of access of investors, especially retail investors, to private markets is on the top of everybody's mind, and very important to ICANN, kind of giving access to those investment opportunities to retail investors who've previously been shut out of those opportunities. I know that Agora has been described as the first network connecting ATS, alternative trading systems, for tokenized and private securities. At the risk of nerding out and without going too deep dive, can you walk us through how it actually works and why that structure matters from a regulatory standpoint?
Yeah, absolutely. So for private securities, as well as for public securities, there are regulatory obligations for trading those securities in a a regulated venue, a regulated marketplace where there are price quotations and transactions occurring. And a lot of that occurs behind the scenes. You never even know that it's happening. A retail investor doesn't even know that it's happening. But every time a transaction happens between a buyer and a seller, then that transaction gets matched using, in the case of our ATS, using our matching technology. And then a number of things happen after that. Notifications get sent out to the buyer and the seller that the trade has been filled. That then generates confirmations that the orders have been processed. And then a settlement process is kicked off to be able to settle the trade between the buyer and the seller. There's also a back end regulatory reporting process, which is actually quite complex. We have to report the trades to FINRA and then to the SEC within 10 seconds of each transaction. So that's a fairly and there are penalties if you don't. If you can't meet that reporting requirement, or if you have a high failure rate of reporting, then it becomes a potential regulatory issue. So in designing the ATSs, there's a lot of work that goes into the technology infrastructure to be able to both ensure that the orders are processed fairly, that people get fair executions, and then that all of the reporting takes place. And so then if you think about saying, okay, well, let's take that sort of general requirement, and now let's add two or more multiple ATSs, how's that going to work? It either requires kind of a complete redesign of the technology to be able to ensure that everybody from every ATS is sort of seeing the same information and executing on the same information. But there's also a logistical issue of figuring out how the trades are going to get reported. So one of the reasons that we settled on the structure that we did is because it allows us to say, okay, we don't have any overlap between the offerings, the listings that are on our ATS and the listings that are on T0. And I think most ATSs that deal in private markets would say the same thing. I mean, the securities are generally not large enough. There's not enough volume. There's not enough interest to have multiple listings in the same securities, at least not in a sort of a regular traditional market making sense. So it's fairly easy because then all we're really talking about is directing traffic to the correct venue and then ensuring that those trades can properly go through that venue and then be reported back up through the ultimate order processing software that puts the order in to begin with. So from a logistical standpoint, what the actual top layer Agora software layer is for processing the trades is it's a kind of a layer of API functions that will interact with our API functions, the application programming interface that connects to our ATS or to T0's ATS. And so it's kind of like almost like a middleware, if you will, to be able to access those market venues from a technical standpoint.
Okay, I see. So is the simplistic way of looking at it, if there's one ATS that has an order that it wants executed, but it can't service that request, then basically you guys will route the order flow to another ATS that can. Is that
Yeah,
correct?
or it's more like when the order initially gets processed at the Agora layer, Agora itself will know where to route the order, and it will know that certain securities are listed at the PPEX ATS. Other securities might be listed at T0. Other securities still might be listed at new ATSs that become a part of the network. And so the idea is, unlike say with publicly traded stocks where there's a national market system and there's multiple listings on multiple venues, this is really more of a problem of a kind of a narrow and broad set of market where there might be tens of thousands of securities that are all relatively small securities, all trade relatively thinly, all have only a single market venue. But the problem is that you might not even know that there is a market for the security because it's not well promoted, it's not well advertised, the market is relatively a niche market. And so the idea is, how do you solve this problem where you have multiple decentralized ATSs, each with their own set of individual securities, and you want to be able to go to one place to be able to get access to all of those. So it's kind of almost like the reverse problem of the national market system, where there's so many orders and so many different venues, and the problem is consolidating them into a single pipe to ensure that the buyers and sellers are getting, the best bid or the best offer.
That makes sense. Thanks.
Jim, you mentioned these, I can imagine, significant regulatory issues that are raised by the Agora structure. Did the tokenization of the underlying assets help with addressing those regulatory concerns, hurt, or it didn't really matter that the assets were tokenized?
Yeah, it's a great question. I think in the early days, well, I mean, we don't really know with respect to Agora specifically, because both of our ATSs, fortunately, have already been approved for tokenized digital assets. So
Right.
eZero might have been one of the first to receive approval, and we were either just before or just after them. We were approved in 2020. So we didn't really ask a specific question about, Agora approval to transact via Agora in this context, because really where it starts to become regulated is when the orders go directly to the ATS. And so once that begins to happen and we see sort of the way that the flow works with Agora, there may be some questions about it, but I don't anticipate a lot of regulatory issues on this specific point. The bigger issue has been more about just the regulation and trading of illiquid private assets generally, because I think the regulators are appropriately concerned about, the same types of issues that exist in public markets: manipulation, insider activity, lack of supervision of orders, and ways that can potentially adversely affect retail investors, in addition to other investors as well. So it honestly, in this case, it hasn't really been a major factor, and most of the issues related to sort of tokenized securities being on regulated ATSs kind of played out 3-4 years ago.
Yeah.
Yeah, I think from a regulatory standpoint, one of the impediments to the development of secondary market and private market has been a blue sky issue that we've been keeping our eye on, and that is the state securities laws regulating what they call non-issuer transactions, or the secondary transactions.
Yes.
And I think most states, you can qualify for an exemption by, they call them manual exemptions, where the issuer is listed in a manual, recognized manual, Moody's or S&P. But nevertheless, that's still having to comply and research, 50 states, non-issuer trading exemptions. Hopefully the new legislation on market, the crypto market bill that the Senate is now working its way through this week, as a matter of fact, hopefully that will address and preempt some of those blue sky regulations.
Yeah, I think you're absolutely right. I mean, we've seen that in the Reg A Plus space, which is where most of the listings on our ATS are, that, you have federal preemption of the state blue sky laws on the primary for tier 2 deals, so-called tier 2 deals, but there's no such preemption on secondary. So we actually have a partnership with a company that we invested in a number of years ago called Guard, that does blue sky compliance specifically for secondary, specifically for private securities. And they've actually promulgated a proposal to allow for preemption, essentially putting themselves out of business at some level, to be, if there were, disclosures in a well-designed and documented format, because, we only get like 40 states with the manual exemption. There's still a number of states that don't allow that, including some of the large states. So then it becomes this big technical problem, like, okay, I want to sell to you, and I'm sitting in Utah, and you may be sitting in a state that doesn't recognize the manual exemption. Whose responsibility is that? Is it the ATS's responsibility? Is it the executing broker, if there's an agency broker involved? So it gets very complicated very fast. And I think a lot of people just throw up their hands and say, I'm not going to deal with it. I mean, that's kind of the approach we've taken on another area with one of my favorite regulatory bugaboos, which is the issue around slots on on funds that are open to accredited investors. I mean, everybody in the market is talking about how we need liquidity for private funds. And, you have 3C7 funds that are only available to qualified purchasers. And, there is sort of a back book for secondary trades in that, but it's not open to everyday investors because of the limitations on minimum net worth. And then you have this whole market of funds and pooled products available to accredited investors. But who's going to set up a secondary market if you're limited to 99 slots? It just makes no sense. And frankly, I've never really understood the 99 investors other than as a mechanism to keep people out of the market altogether or to keep the market purposefully small. So I think you're absolutely right, Mark. There's definitely, issues from a regulatory standpoint that have acted as a curb on the market. And we hope that we will get some of those things relaxed, in the next round of legislation.
Yeah, in fact, with respect to 3C1, the number of investor limitations on investment company private funds, the House passed about a month and a half or 2 months ago, capital markets bill, and that includes an expansion of the number of investors that would be allowed in those private funds, as well as a couple of other changes that will affect and hopefully facilitate capital for private markets. But while we're on that subject of capital raising, how do you envision Agora changing the way capital is raised, traded, and accessed in private markets? And what does that mean for the long-term trajectory of asset tokenization?
Well, I think my hope is that by expanding the market potential for secondary trading, that there will be kind of a reverberating effect on the primary markets. At the end of the day, the main reason that I think people, investors in particular, and then, some of the insightful issuers who have kind of gone in the direction to facilitate secondary trading, the main reason is because it makes their issuances more attractive, right? I mean, the private issue where you invest and you may or may not get your money back is rarely going to be a good investment, right? And even if it ends up ultimately being a good investment, it may take a very long time before you see a return of capital or any return. I sort of joke about, the one investment that remains in my portfolio from 1999 there's still one company in that portfolio and we're waiting for that liquidity event. But, that's been a 27-year private investment. And if there were some ability to transact in that, then I would happily give up some of the upside to get out of the position and sort of put a pin in that. And I think there are many other investments of that type that people deal with all the time. The ability to have secondary listings and secondary trading doesn't guarantee liquidity, but it guarantees the possibility of creating liquidity. And so to your point, what's going to drive capital formation is making the private investments more like public investments in terms of access, liquidity, transparency in ways where, we're really the only difference is the cost. And that's, I think, still what's driving private market activity is it's hundreds of thousands of dollars less expensive to do private offerings than to do public offerings. And so I don't see any slowdown in private markets. It's just going to be, can we add features to make, some of the weaker aspects of private markets more like public markets, better disclosure, better access, better liquidity. And that percolates through to custody as well. I mean, how many people have private investments that aren't held with a custodian? They're held, in the name of the issuer at 15 different transfer agents. So that's another area where I think we have a big possibility to improve the market infrastructure with blockchain.
Jim, at ICANN, we are singularly focused on regulatory impediments that keep ordinary investors out of markets. On that issue, and from a public policy or regulatory perspective, you've mentioned in passing some FINRA requirements, a possibility that Congress might step in and help on issues, some blue sky things. Obviously, the SEC has a big role here. If you had your magic wand, or if you could identify one or two of the top regulatory issues that you think need to be addressed in order for tokenization to reach its full potential, what are those topics?
Boy, I think that's a great question. And I've actually, I wrote an article a few months ago about, I think it was something like the 3 things or the 5 things that we could do to improve secondary market liquidity and sort of market infrastructure around privates. And we've talked about some of them here. I think the 3C1, 3C7 issue is a big one, because I think if we had a structure where we really weren't concerned about slots, and we had some sort of safe harbor or some sort of a limited investment ability in a Reg D offering, then that just opens up the potential interest, and eliminate some of the regulatory deterrents that exist today for issuers to want to embrace a secondary market for their securities. So I think that's definitely one, is just making these products able to be traded without running afoul of the existing regulations that either are not well established or specifically prohibit the secondary trading. I think in that same vein, the other issue that comes up a lot is the PTP issue, publicly traded partnerships, because a lot of private funds and even private companies are organized as private partnerships for tax reasons. And then if one then decides to sort of list those partnership interests on an ATS, then there are fairly complex rules related to not becoming a publicly traded partnership, or if you are a publicly traded partnership, complying with the tax requirements to not require punitive tax treatment, that again keep people out of any desire to do listings. That's even a problem with large 3C7 funds. I mean, the reason why, people talk about the secondary markets and in private funds, I mean, they're not really markets. They're kind of more like, dating apps, right? They're like, people kind of make appointments to sort of, see who might be interested, but it's not like there's a transparent market with market depth and price transparency. And I think that, I mean, I'm a big believer in markets. I've been in markets for 40 years, and usually in public markets with deep liquidity and very transparent operations. And I've always found that no market has ever benefited from less transparency and less access. And so whenever we've done things to make markets more liquid, more accessible, more discoverable, it's always ended up better for investors. And so, to the point of your mission, if the goal is to help investors, not just to protect investors, but to really help investors, then I think that really adding and sort of eliminating regulations that hamper the development of secondary markets is one of the best things that we can do, because the market will take care of the rest of it. I mean, the market will then bring these products to market, and we'll find the market clearing price, and then investors will be able to get in and will be able to get out.
We have this system of the public securities markets where the plumbing works pretty well. We have zero commission trading, and specifically in the area of tokenized securities. What benefits are there to tokenizing securities?
I think the main benefit for private securities is that we can recreate, using blockchain, some of the same types of systems that we have in public markets. And there's a lot that works really well in public markets, and for the folks that are participating in private markets, they're not participating in private markets because they don't like public markets. There's a lot to like about public markets. It's more that they're looking for opportunities that may not be available in the public markets. And from the standpoint of the issuers and the intermediaries, the economics work much better to be able to get smaller offerings out into the market and available. So I think that most of the people that I know in private markets would like it if private markets worked more like public markets in terms of access, in terms of liquidity and transparency, but there just isn't the infrastructure to allow that to happen until now.
Yeah, so I guess the better question is, can the existing plumbing for public markets accommodate trading in private market securities? And one of the issues I see, and this may be too far afield, but what we're trying to do is identify with respect to crypto and tokens, investment contracts that should not be considered securities and not regulated as securities. And so, what we're talking about here is taking privately held securities and kind of porting them over to this new regime that will be instituted by Congress at some point, with the hope of not having to deal with all of the regulatory burdens that burden public securities markets with the benefits. So one question I have for the regulators is, and they've been saying this, are they going to treat, Hester Peirce keeps saying, digital assets that are securities are still going to be subject to the securities laws.
Right.
And so is there maybe there's a reason to treat private securities, which are clearly, private equity that common stock that's privately held and not registered under 12G. Is there a reason that we can't accommodate those securities in the public market plumbing?
I see what you're asking. I think the answer is no. I mean, there's no reason we can't. I think the question to ask is why haven't we? And why hasn't it happened? And I think the reason is because there's too much institutional resistance to kind of moving down market into these private securities. And that will continue. It may, even if things were liberalized, I think you would still have the problem that okay, maybe a $20 million private placement is still kind of at scale where it could fit within the existing system, but then you keep sort of moving down market and you get down to 5 million or a $2 million offering, and at some point it just becomes non-economic for a lot of the traditional structures to be able to accommodate that. When you think about listing fees on an exchange of $10,000-$15,000 a year, audit requirements of DTCC compliance requirements. I mean, they're like, think about even until a few years ago, large scale private placements, $100 million, multi-$100 million, billion-dollar private offerings couldn't be cleared in DCCC for normal, for kind of normal dissemination through broker dealers and their client accounts, because there was no system that adequately handled that. Now we have the AIP system, which is specifically designed for alternative funds, but there's some very big holes in that. Like, they don't handle private debt. It doesn't handle certain private individual stocks. So I think that the private markets are continually innovating, continually moving down market, making it economical to do, smaller offerings with smaller numbers of people. And the market wants those offerings to be treated similarly to public offerings from the standpoint of the listings and the settlement cycle and everything associated with the mechanics of doing the deal. But the existing systems just aren't built for that type of scale, and reverse scale, in a sense that deals that are small enough. But there are other systems that could do that, and I think blockchain is kind of our highest and best hope to be able to get there.
Yeah, maybe that's the answer, that it's really not efficient to accommodate, as you were describing earlier, multitudes of issuers with the current public securities system. I mean, because what I think is in the back of Hester Peirce's mind is, when it comes to tokenized securities, we're talking about fundamentally about the asset we're talking about is the company. And for what reason would we differentiate, public versus private? Well, there's a cost. And historically, retail investors haven't participated in private offerings of private companies. On the other hand, with real world assets, it doesn't make sense to subject a piece of real estate to the disclosure requirements of Section 12 that are applicable to an operating company. And so to me, there's a reason to create a whole new regime for regulating and reporting. But I can see an argument when it comes to tokenized securities in operating companies, that we've already got the regime in place that's worked for public companies, just needs to be scaled back for private companies. But maybe the answer is it's not possible. It's not efficient to list and trade and have transparency in all of these privately held securities.
Well, I think there's also with example for the private company stocks that you mentioned, there's also a difference between kind of the small scale, sort of family business or regional business that's trying to raise a few $1 million of capital and will pretty much continue to operate at that level with third party capital that's raised in a private transaction, and say a company like SpaceX, which, if and when it eventually goes public, will be one of the most highly valued public companies, in the market, most likely. Um, so in those circumstances, you see a lot of activity happening, which I think is counterproductive to retail investors, where, only certain people can get in. People manufacture all sorts of feeder fund structures and convoluted structures specifically to avoid, non-compliance with regulations that don't really contemplate widely held, highly valued private companies. And so you end up with this kind of hodgepodge of vehicles that are not serving investors well at all. I mean, they're anything but transparent. In some cases, I think some of them are outright fraudulent. The SEC has actually talked about some of the fraud in sort of, private markets for these highly valued, quote unquote, pre-IPO type companies. And so I think the way to address some of that is to make the disclosure requirements, fairly clear and eliminate some of the what I would call sort of administrative regulations that don't add a lot of value, such as, 99 investors in a 3C1 fund. I mean, like, who does that actually benefit? And so I think that there is a lot of scope for, not necessarily reducing the amount of disclosure or anything like that, maybe requiring more disclosure, maybe providing guidance around a private disclosure framework that would allow companies to be able to, facilitate secondary trading in their shares, but only if they met those disclosure requirements. It's not that hard, to say, get an audit, especially if you're a multi-billion-dollar company. It's not that hard to file regular financial statements. And so I think there are definitely steps that could be taken without completely trashing the existing securities framework for private companies. And that might go a long way of sort of both improving the market for investors and bringing in some of the liquidity and transparency and the things that we've talked about.
Yeah, you probably know David Wheel. We had him on,
Yeah.
a few weeks ago, and his solution, which he's been advocating for years, is to have that marketplace, that kind of earlier stage marketplace, public marketplace. And I think at one time there was a lot of traction for that idea. I don't know, kind of went by the wayside, but I think you're right. That would address some of these issues.
One of the things that I think the regulators have to struggle with, and I'm very empathetic, is that there are a lot of people with a lot of crazy ideas. I mean, there's some great ideas too, but there are some crazy ideas, like we should just get rid of securities regulations. And, so I think they're trying to, kind of navigate not just sort of the realm of reasonable ideas, but the realm of crazy in addition to the realm of reasonable ideas. And so I think that's why, I mean, Hester Peirce has been nothing but an advocate for innovation and, and especially with respect to blockchain. So like, it doesn't really, I don't, get too worried when she says, look, these are still securities and they're still going to have to follow securities regulations. I mean, the SEC has a lot of latitude to amend and modify and give guidance around securities, regulation as well. And I feel like they certainly understand what the issues are. And I've been ecstatic about how much progress has been made in the past 13 months. I mean, I just think it's remarkable.
Yeah.
I would say also, if once you get, if we had a better disclosure regime for private companies, I mean, it almost makes it impossible to still have the accredited investor rule at that point.
Well, and I think that there are a lot of, and you guys have written about the different, initiatives to, to relax or to liberalize or to change, modify the accredited investor rule. And I think this idea of having a sort of an education based exemption is very valuable and sort of seems in keeping with the spirit of the rule. I think the other exemption would be very valuable is to have some sort of a, an income or asset-based limit. Because I sort of feel like if you can take, $5,000 and go to Vegas and bet on the red or the black, then you should be able to take $5,000 and invest it in any crazy idea that your brother-in-law might come up with without, violating the Reg D 506C exemption. So there's that as well. And particularly in the context of a portfolio, I think there's room in everybody's portfolio to do something that's a little bit speculative if they want to do that. And if they don't want to do that, if they want to play things safe, well, that's fine too. But it's not really the government's job to sort of tell people what they should do.
Boy, that's a great sentence to end on, Jim.
As long as I don't get in trouble.
Right. Well, hopefully not. But maybe we'll leave it there. We're needless to say, we are very excited about your development with Agora, and it definitely sounds like a step in the right direction. And maybe we can check back in after a few months, and maybe it'll be populated with a bunch of ATSs. That would be really exciting. Thank you for coming on. And Dara and Mark, thank you as always for co-hosting. Well, and for everyone else, if you want more information about ICANN, you can go to icanlaw.org, and we'll see you on the next episode of Capital Ideas. Thank you.